Ray Dalio, famous for his ability to predict market downturns and one of the world's greatest investors, has recently released another article. Within it, he discusses how the world today looks very similar to how it did in the late 1930s. Why is that important? In the late 1930s, the US stock market suffered a terrible crash. After a resurgence from the Great Depression, the US stock market again crashed in 1937, this time taking a staggering 17 years to return to its previous heights. Oh, yeah. And in the late 1930s, the world was also on the brink of a Second World War. In this video, I'm going to do my best to summarize Dalio's views, why he believes the world is at a critical junction, and how you, as an investor, can protect your investments, potentially even growing them. It is important to note that the following opinions and conclusions are those of Ray Dalio, not myself, unless otherwise stated. I mention this now because Dalio discusses the US, often not in the most positive terms, but we as investors must push through our biases and take an objective stance, as Dalio himself is able to. Let's begin with the why. Why does Dalio believe today's global conditions are similar to those of the late 1930s? There are three main conditions that he highlights. Condition number one. Today we are witnessing the largest wealth and political gaps since the late 1930s. With this, we have the emergence of populists in both the left and right wings of politics, very similar to the 1930s. Populism refers to a range of political stances, with the key tenet that they emphasize the idea of the people and often position this group against the elite. Why is populism on the rise? As with all things, there is no one singular reason. However, the most significant cause could be considered the wealth gap between the poor and the rich, or between the people and the elite. In fact, Dalio goes as far as to say that it seems reasonable to worry that the gaps between the rich and the poor, and the populists of the left and the populists of the right, will become more warlike, and that the consequences of their fighting could undermine the efficient operation of the economy as well as the efficient running of government. He also highlights that this conflict is likely to lead to reduced respect for the law and the increased use of emergency powers by governments to gain more power than those emergency acts were originally intended for. Condition number two. The limited ability of the world's central banks to stimulate their economies in the event of a negative economic downturn. Again, today's situation is highly similar to the late 1930s. Typically, in order to stimulate an economy, governments will implement several methods. One of the most notable is the lowering of interest rates. Think about it. When businesses can borrow money more cheaply, they can more easily use that money for growth, which in turn stimulates the economy. However, as noted in my last video on Dalio's thoughts, paradigm shifts, interest rates are already at historic lows in many countries globally. In fact, a few countries even have negative interest rates. That's right, with a negative interest rate, you are paid to borrow money. While central banks may drop interest rates further, something we have already seen in the past months, this time they have little room for maneuver and will likely look to alternative methods. Dalio believes two key methods are likely. Number one, substantially raising taxes on companies and the rich. Number two, the printing of money by central banks, also known as quantitative easing. The result of these two things could lead to a situation where those with money attempt to move their money out of the country in order to avoid the issues caused by these two approaches. As a result, countries are likely to begin implementing capital controls, not allowing this money to leave the country so that it can be taxed, and in the case of fiat currencies, devalued through quantitative easing. Before I tell you about the third overlap between today's climate and the 1930s, let me first tell you about our monthly competition, which is entirely free to enter. Every month, I join a subscriber for a free 30-minute video call. If you'd like the chance to win this month, all you have to do is the following steps. Number 1, like the video. Number 2, subscribe to the channel. And number 3, simply comment what you liked about this video along with your Telegram username so that I can reach out to the winner. It's that simple, so make sure you enter now before you forget. Back to it. Condition number 3. Similar to the late 1930s, there is a rising power that is challenging the existing world power. Today we have the existing world power of the US and the rising power of China. Dalio believes that this face-off will likely lead to more conflicts in the future and, if history is anything to go by, an increased risk of war. He highlights the 4 main categories of war that this could lead to. Number 1, trade wars. This much we have already witnessed in the past year between the US and China. Number 2, capital wars. Here we must consider that the US president has the ability to unilaterally cut off capital flows to China, freeze payments on the debts owed to China, and also use sanctions to inhibit non-American financial transactions with China. Considering that the US president has just yesterday, at the time of recording, threatened to obliterate the Turkish economy, we must understand the real likelihood of a capital war in the coming years. On the flip side of this, imagine what would happen to the price of US bonds if China began to dump them. Today's situation mirrors the late 1930s and early 40s, with the US's freezing of Japanese assets and the embargoing of oil deliveries to Japan. Number 3, technology wars. Again, we have already seen this in recent times with the US's stance towards Huawei, a Chinese tech company. And finally, number 4, geopolitical wars. In a geopolitical war, countries must decide whether they align with China or the US. Typically, countries will make this decision based on both their economic and military calculations. According to Dalio, the economic calculations have one clear winner for almost every country without exception: China. It should be noted this calculation is not based simply on the size of the two economies. Instead, it is how each economy affects your own, with China being larger in terms of trade and capital inflows being the key factors. On the military front, the US is winning. However, they are showing less likelihood in recent times of supporting countries via military means. On top of this, China's own military capability, especially their cyber divisions, are growing rapidly. On the balance of both economic and military considerations, Dalio believes that China are winning the geopolitical war and are likely to continue moving further ahead in the coming years. What can investors do? With all of this doom and gloom, you may be wondering to yourself, what can we as investors do? In my previous video discussing Ray Dalio's views on paradigm shifts, we covered extensively how he views the world's economy shifting in upcoming times, and how investors can not only protect their portfolios, but even see growth during this tough period. I'll provide a brief summary here, but I'd strongly recommend checking out that video too for more extensive details. The link is in the description. Dalio highlights the importance of safe havens, in particular, gold. A safe haven is an investment which is generally uncorrelated or negatively correlated to traditional investments such as stocks, real estate, etc. During times of economic uncertainty, investors look to these investments as a method of hedging their portfolios in case a downturn is around the corner. In the last video, there were several comments about how Dalio hadn't directly said everything I covered in the video. While I believe I was quite clear in expressing where the video moved away from Dalio's thoughts and towards the thoughts of other economic experts or my own opinions, I'm going to make this video even clearer. That point is now. We've just discussed the importance of safe havens during negative economic times. But you might be thinking at this point, why not just not invest until all of this plays out? In other words, why not choose to leave your money in cash instead? While some may view this as a non-investment, and during many times in history that may have been the case, you must consider quantitative easing. As discussed earlier, quantitative easing is the printing of money. We know from Economics 101 that an increased supply of any good generally leads to a lower valuation of this good. In other words, an increased supply of fiat currencies may decrease their relative value to items you wish to purchase in the future, i.e., inflation. While inflation is a complex matter and isn't determined solely by the supply of a currency, many experts believe that the artificial printing of money may lead to higher inflation rates in the future and thus currency devaluations. Therefore, any investor considering holding cash must realize that this isn't a non-investment. Instead, view it as an investment into cash. If this is an investment you're happy holding, then by all means do so. I am certainly not here to tell anyone what they should do or what they should invest into. My only aim is to point out that cash is an investment choice, and you should consider that implication. Dalio highlights gold as a safe haven and a market hedge. As noted earlier, this is due to gold's negative correlation or lack of correlation with traditional investments. For those who have been following my journey for some time as a cryptocurrency investor, you're probably aware of my thoughts on Bitcoin. If you're a gold bug who doesn't like Bitcoin, maybe you were burned in the 2017 Bitcoin bubble, or perhaps you simply don't want to hear about Bitcoin today, no problem. Feel free to end the video at this point. I hope that you've enjoyed the content so far, and I'd really appreciate if you could just leave a like on the video, as I've put in a fair amount of work to create this, and it helps with YouTube's algorithm so more people can see this content. If you would like to hear about Bitcoin's lack of correlation with traditional markets, making it a potential market hedge, feel free to continue the video. For anyone who is anti-Bitcoin at this point, don't say I didn't warn you. In today's investment arena, fund managers regularly use modern portfolio theory to influence their investment decisions. Modern portfolio theory dictates that an ideal portfolio will contain a mix of uncorrelated investments. In 2019, Bitcoin has been the best performing asset and exhibited a lack of correlation with other investments during this time. Therefore, Bitcoin fits extremely well with modern portfolio theory. This is why I believe that Bitcoin could continue to be a high-performing asset in the next few years, based solely on the provable mathematical improvement to a portfolio that investors receive by investing 1 to 2% of that portfolio into Bitcoin. The key for me here is the mathematical angle. If you approach a fund manager and say that he or she should invest into Bitcoin because it is going to be the money of the future, this is a nigh on impossible sell. However, if you can mathematically prove to them that by investing just 1 to 2% of their portfolio into Bitcoin, they have a higher potential upside along with a lower risk because of the diversification, the conversation is likely to go significantly better. Having said this, let's do our best to be impartial and consider the alternative, the potential negatives for investing into Bitcoin. First, it should be noted that the investment size discussed is only 1 to 2% of a person's overall portfolio, nothing more. This is a highly volatile asset class. Be sensible. Secondly, some view Bitcoin not as a safe haven or market hedge like gold, but instead a risk-on investment. For those investors, a general market decline may persuade them to focus more on safer assets and turn away from the likes of Bitcoin. To this point, I would somewhat agree. I would say that I personally believe that the majority of fund managers actually do and will continue to take this negative view of Bitcoin in the next year or so. But those fund managers are likely already not invested. To see an increased number of fund managers globally investing into Bitcoin doesn't require the majority to view it in a positive light. In fact, because so few large funds are currently invested in this asset class, even a small percentage of them taking a positive view on Bitcoin would likely lead to a greater number of investors. Whether you're a big fan of Ray Dalio or Bitcoin, I hope you've enjoyed this video. If you don't like Bitcoin, I hope the beginning and middle sections of this video were more to your liking. If you're a big fan of Bitcoin, you may have liked the ending. I also hope that I've been explicitly clear this time round about where I've added to Ray Dalio's thoughts and included my own. If you've enjoyed this video, I'd appreciate if you could leave a like, as this has taken some significant time to put together, and even a single like helps the YouTube algorithm so more people can see this video. Finally, remember to subscribe and turn on notifications so you don't miss any future content just like this.